Hi everyone, welcome back to the Young Investors webinar series. I know many of you have probably been to the last few sessions and you're probably quite bored of hearing me introduce myself, but my name's Rachel. I'm one of the investment managers here at Killik, and on the screen here with me we have Tim Bennett, who's one of my colleagues. He is our head of education and he's the editor of the Killik magazine. And then behind the scenes, we've got my colleague George, who will be manning the questions box. So if you have any questions throughout the webinar, pop them in the chat box and we'll do our best to answer those at the end. So let me just share my slides again. Just to remind you of the sort of agenda that we're running through over the course of these 5 webinar sessions. I can't believe we're this close to the end. I mean, this is number 4 of 5, so we've only got one more after this. But here's a summary of what we've done so far and what we've still got to come. So in the first session, we gave you a few ideas about how to look for your own investment ideas. And then after that, you went away and looked for your own ideas. Then we had a vote and we decided what to put in our virtual portfolio. And since then, we've been following that virtual portfolio. Last week, we looked at a few different ways of deciding whether a company was a good investment, and we looked at some basic financial ratios. And this week onwards, we're going to be looking at our virtual portfolio in a bit more detail and looking at how it's performed. And Tim is going to be doing a quick talk on exactly how to buy shares. So that's what you've got to look forward to over the next couple of weeks. Before we start, just a reminder of exactly what we have in the virtual portfolio. So we've got a selection of 12 different shares from different countries all over the world. We've got Alphabet, which is the company that owns Google and YouTube. We've got Amazon, which obviously is a massive online retailer. It's also very big in cloud computing, and it also owns Twitch. We've got AB InBev, which is the biggest beer company in the world. We've got AstraZeneca, which is a big pharmaceutical company, and it's making a lot of the coronavirus vaccines. We've got Beyond Meat, which is making meat substitutes. We've got IAG, which is the owner of British Airways. We've got Lloyds Banking Group, which is one of the biggest banks in the UK, and it's making money from lending money to other people and to businesses. We've got Newmont Corporation, which is the world's biggest gold mining company. We've got NIO, which is a Chinese electric vehicle manufacturer. We've got Northland Power, which is a wind farm developer. We've got Peloton, which is an interactive fitness company with a focus on cycling. And then we've got Xylem, which is a water technology company. So we're going to start by having a look at exactly what's happened in the market since our last session. And I know it's only been 2 weeks, but actually quite a lot has happened in there. And we've actually seen quite a big move in some markets. So we've got quite a lot to talk about, which is good. One of the main things that have been talked about in the markets in the last couple of weeks is inflation. And that's something that we talked about in our first session. And I showed you this chart, which shows the price of a Big Mac and how it's changed over the last 20 years. So you can see back in the year 2000, a Big Mac cost about $2.50, and now it's just under $6. So the price really has gone up quite substantially. And that's quite typical of most products and services. Prices are rising all the time, and that's what inflation is. It's simply the rise in prices that's happening every year. And generally speaking, a little bit of inflation is seen to be a good thing because it stimulates economic demand. So for example, imagine that I want to buy a car. If I know that that car will cost more next year, I'm more likely to try and buy it this year. And that kind of thinking keeps the economy moving. Whereas in countries like Japan, for example, they really have trouble with something called deflation. And that's when prices are falling. So instead of people thinking the price is going to be higher next year, I'm going to buy it now. Instead, people think it's going to be cheaper next year, I'm just going to hold on. And then they think the same thing next year and the year after, and no one ever buys anything because of that. So that's really, really bad for the economy. So ideally, you want to have an inflation rate of around about 2%. And that's seen as being a fairly good level. And the role of what we call central banks around the world, so that's the Bank of England in the UK and the Federal Reserve in the US, their role is really to keep inflation at that 2% level. If inflation gets too high, they will raise interest rates to try and bring that inflation down. And what that does is it encourages people to save and it discourages companies from borrowing. And both of those things combined mean that people will spend less in the economy, and that will bring down demand and that level of inflation. If inflation is too low, on the other hand, these central banks will lower the interest rates. That makes it cheaper for people to borrow money, and therefore they're more likely to spend. That's going to raise demand and bring up inflation again. So central banks really have complete control of interest rates, and the purpose of that is to control inflation. Also on the subject of inflation, this is the price of Brent crude, which is the main type of oil. And this is what it's done over the last year. So you can see back in March last year, it was about $35 a barrel. Now it's basically double that. It's $70 a barrel. And this could really start to impact inflation in future, because even though we're trying to move away from fossil fuels, they're still a really, really big part of our economy. They're fueling most cars, they're fueling pretty much every lorry, and they're fueling pretty much every airplane. And they're also used to fuel factories as well. So for example, if you're running a factory, you've got to buy oil to run that factory. If that oil becomes more expensive, your costs are going to go up and you're probably going to have to raise your prices. Even for a company like Amazon, where you're so dependent on deliveries, if the oil price goes up, those deliveries are going to cost you more. So this higher oil price could lead to inflation further down the line. And because investors are so worried about inflation, that has led to quite a big sell-off in some parts of the stock market. So if you've bought a stock that was quite expensive, but you thought it was worth paying that high price for because you thought that company would grow really fast, if inflation starts to rise, and then you think that central banks will start to raise interest rates and try and slow economic growth, then perhaps that means that the company you've bought will no longer grow that quickly, and perhaps therefore it wasn't worth that high price that you paid for it. So because of these inflation fears, which have led to these fears of higher interest rates, we have seen quite a big sell-off over the last couple of weeks in expensive growth stocks. And unfortunately, within our portfolio, we do have quite a lot of those types of stocks. So if you have noticed that our portfolio has fallen, part of the reason is this sell-off in growth-orientated stocks. Now, in previous weeks, we've talked about indices or indexes, and these are simply a way of measuring what's happening in particular stock markets. And the main ones that we've looked at so far are the FTSE 100, which measures the biggest 100 companies in the UK, and the S&P 500, which looks at the biggest 500 companies in the US. There's also another very popular one called the Nasdaq Composite, and this measures the performance of companies on a particular stock exchange over in the US. And most of these companies are very high growth and they're very technology orientated. So if you have a look at the blue line on this chart, you can see the performance of the Nasdaq Composite over the last year. And you can see it performed really well throughout the first part of the year, but it sold off quite heavily over the last couple of weeks. And the reason for that is these concerns about rising interest rates. So the Nasdaq Composite, it really is, as I said, very heavily focused on technology stocks. But I just wanted to show you exactly how focused it is. So 11.3% of this index is invested in Apple shares, 8.4% in Microsoft, 8.21% in Amazon. So just those three shares alone really account for a very large proportion of the index. So any movement in any one of those three shares can start to move the entire index. So because those shares have come down over the last couple of weeks, that's brought the whole index down with it. Now this chart here, again, we've got that Nasdaq Composite over the last year. So you can see it rising and then dropping off over the last couple of weeks. And what we've done, we've compared that to something called the 10-year Treasury yield. And we won't go into that in detail, but it really shows the expectations for future interest rates in the US. So you can see that that tends to move in the opposite direction to the stock market. So you can see that for the first part of the year, expectations for interest rates were going down and the Nasdaq Composite went up quite sharply. Whereas in the last couple of weeks, the expectations for interest rates, shown by the pink line, have come up quite steeply, and that coincides with the Nasdaq Composite selling off. So growth-orientated companies do not tend to like rising interest rates. And now I'm going to pass over to Tim. He's going to talk to you about how to buy shares. Over to you, Tim.
Okay, great. Thanks very much, Rachel. Great to be back again in front of you. And this time, as Rachel said, I'm going to do a little bit of a jargon-busting tour of how to buy shares and introduce the roles of one or two people in the city, and also explain some of the decisions you need to make if you are going to buy shares, as obviously a lot of you may be thinking of doing so. So basically, what do we got? Imagine you want to go out and buy 1,000 Tesla shares, let's say. You've just had that thought. You could step outside and see if anyone wants to sell them. But frankly, your chances of finding someone who wants to sell 1,000 Tesla shares, agreeing on the price, trusting them to deliver them to you, them trusting you to come up with the cash, it's a lot to ask. And frankly, doing an over-the-counter, as it's called, or in the street, as I would call it, deal that way, is time consuming and messy. So a better bet is to use the market, whatever that means. Now, using my daughter's props, I've prepared a little diagram to save time here of how the market works. So you're on the left, if you like, as you're looking at that, you are looking to do a trade. So a quicker way of doing it is to go to a broker. That's the slightly podgier person in the middle, well-fed. And then on the right, you've got the market. And the point is the market operates a bit like a club. You can't necessarily join it as an individual investor, but a broker, an intermediary, can. And the club, broadly speaking, comprises of 3 organizations involved in getting from a deal in shares through to final settlement, which is where legal title and cash change hands. So you've got the London Stock Exchange, LSE, that's just a market where lots of buy and sellers are brought together centrally, saves you having to go and find one. And they're all linked together. And basically the London Clearinghouse then guarantees trades that are routed through the London Stock Exchange. It does that by margining its members. Those are the brokers. Most people don't worry about that as individual investors on the left-hand side, but it guarantees the trade. It stops somebody running away without paying and somebody else running away without delivering 1,000 Tesla shares, for example. And then the Euroclear bit is the bit where you actually settle the transaction. So quite a few big city institutions involved behind the scenes in allowing a broker to do the trades on your behalf. Okay. Now, that then begs the question, what sort of relationship could you have with this person in the middle? Well, the answer is there are 3 types of relationship. Execution only, that's just taking an app, basically giving an instruction, buy 1,000 Tesla shares, job done. You know, talk to anyone, all of that stuff I talked about, the plumbing happens behind the scenes and is part of the commission that you pay. Then there's taking advice. So you could have a phone call with a different type of broker, talk about what you're trying to achieve, build a portfolio, add 1,000 Tesla shares to it. And then the last level is discretionary management, where you basically say to a broker, here, look, here's some money, go away and invest it, taking into account, you know, my risk tolerance and my objectives, and let me know every now and again how I'm getting on. And that's called discretionary management. So you've got XO, as it's called, some sort of advisory relationship, and then full-blown, somebody else looks after my money for me. And the cost of those will obviously vary, but it's not all about the cost. So how would you make the decision? Do I want just an app? Do I want to talk to somebody? Do I want to give them a chunk of my money to look after and run a portfolio? Well, here you go. Essentially, again, using my daughter's high-tech equipment here, you'd have to take into account how much you know about the markets. Do you know a lot? Do you know a little? And you've got to be honest about that. How much interest do you have in it? I mean, frankly, if you've got no interest, but you want to make a decent return, maybe you just hand it all over to somebody else. Who knows? What services are you looking for? Do you just want pure vanilla buying and selling of shares? Or are you looking for other things around the edges? That might influence who you choose. Maybe some of those things are not available through an app, for example. And how much time have you got? You know, are you retired and you've got a couple of hours a day to leaf through the FT, make some informed investment choices? Or are you far too busy for that, frankly? So lots of things go into that decision. You know, shall I just use an app, execution only? Do I need to talk to somebody, get some advice, or would I rather just hand the whole problem over? All right. Now, on that note, I talked about the cost of doing a transaction in shares, let's say. There is a hidden cost I just want to mention. So when you buy and sell shares, there will be a commission of some sort, maybe low, maybe a bit higher, depending on the level of service and the broker that you choose. There'll be some fixed costs. So there's stamp duty. You pay that as the buyer when you buy shares. If you ask for certificates, not many people do that anymore, then you pay a little bit more on top. So most people are happy to do this electronically, as it's called. You may have parents and grandparents who still keep share certificates, but an awful lot of people don't worry about those anymore. They're not legal proof of ownership like they used to be in the old days. So you've got stamp duty, you've got commissions, and you've got spreads. I want to talk about spreads because people don't advertise spreads much. What is a spread? A spread is a way for that broker in the middle of my diagram at the start to make money on a share transaction. And it is the gap between the price at which you buy shares through a broker and the price at which you sell shares. And not surprisingly, a bit like second-hand car dealers, they don't thank me for likening them to second-hand car dealers. They're trying to make a bit of money. So if you take a second-hand car into a dealership and say, I want to sell this, they offer you one price, go back 2 days later and try and buy the same car, and mysteriously the price has changed, not in your favor. Okay, well, share trading works like that. There is a mid-market price, which is what you see in the FT, for example, or on a screen. And then around that, you've got a price at which shares are bought and sold. And you're going to pay a bit more as the buyer to a broker. You're going to receive a bit less, if you like, if you're looking to sell shares. And that gap's important. It can be quite narrow on heavily traded, very liquid securities, FTSE 100, for example. But if you're looking at less liquid shares, shares that are not traded as often, that spread not only can be fairly significant, it can eat into the overall profit you make on your trade, because in effect, you are buying high and selling lower, if you like. And it's worth, therefore, kicking the tires, asking the question, how much is the spread? And also, will it move? So liquidity, if you like, the ability to trade an asset influences the width of that spread on shares, on certain types of fund, on all kinds of assets. So it's important to also track how that's changing over time. It might not change very much on a very liquid, popular share, but on something less popular, less liquid as the market calls it, it could move. Now, let's say you're all set up, right? You've decided you want to go out and buy shares. You've got the broker you like, whether that's just a simple app, whether it's a human relationship because you're going for an advisor or a discretionary management arrangement, as they call it. You understand the costs, you're ready to go, you feel informed, you're up for it. What are the classic mistakes that lead investors not to make as much money as perhaps they should, even relatively well informed? Well, again, no expense spared here. I'm going to hold up some post-it notes with 4 of the most common investing errors I tend to come across. There are loads more than 4. Happy to tell you about those in another conversation. But here's one. Okay, told you it was high tech. Gambling, not investing. Now, this tends to happen where people use apps to bet on single stocks. Single stock investing is dangerous. I've talked about this before in the context of Robinhood and GameStop and so on, but basically single stocks, that's not proper investing. You want a diversified portfolio of stocks that will behave and respond in different ways potentially. Otherwise, you're leaving yourself really tied to the fortunes of one management team and one company. So I call single stock investing gambling, not investing. Then here's a big one, market timing. I was talking to the UK's most arguably successful fund manager last week, Terry Smith, and he said, he's been quoted many times as saying, there are people who know they can't time the market, and there are people who haven't found that out yet. And essentially, market timing is people being a little bit clever. And I saw this actually, I couldn't believe it. I won't name names, in a national newspaper recently, famous commentator saying, I think it's time to take some money off the table in America. I was like, how can you possibly know that? And he even said, in May. And I was like, crikey, I don't know what you're drinking, but I'd like to have some of it. So people who try and time the market are usually disappointed. It's incredibly difficult to do because you're trying to beat professionals, algorithms, your friends down the road who know a bit more about a particular stock than you do, all the professional analysts out there. And some of my best friends are analysts, as they say, and they get it wrong. So heaven knows, what chance most of the rest of us have got. So basically, market timing's another no-no. 2 more to go. Here's one, and you might think, cool, he's got a cheek with this one. Ego, all right? Ego is basically overconfidence. We all think, and this has been tested in straw polls, you'll be sitting there thinking, I'm not overconfident. I bet you are. There was a period in my life where I thought I was an above average driver. I still think I'm above average driver, but by definition, not everyone can be an above average driver. Equally, I think I can hold my beers. I think I'm better at holding my beers than most people out there. But by definition, that's probably not true. We can't all be above average. And in trading terms, overconfidence can basically lead to people not accepting that they might make a mistake and keeping quiet about mistakes. The people who brag in the pub, God, look at the turn I made on this particular stock, often keep quiet about the one they had a nightmare with 2 weeks ago, because that's human nature. Survivor bias. We talk about the winners, we tend to forget about the losers. And then finally, and this is not by any means the last one, these are human emotional biases that get in the way of making money and investing. Anchoring. And people do this all the time. They say things like, I'm not selling this stock until it gets back to what I paid for it. You might think, what's wrong with that? Well, it might never get back to what you paid for it. What if things have changed? I've bought stocks occasionally that have just gone down and down and down and down, waiting a long time to get back to what I paid for it. And people anchor to the past. They anchor to indices and they say, well, back in X year, the index was at Y level. And I think circumstances are similar. But, as the famous quote says, history never repeats itself. At best, it rhymes. So we can learn things from the past, but we shouldn't expect to just draw a straight line through a chart and go, well, X must equal Y must equal Z. It doesn't work like that. So these emotional biases are one of the reasons people sometimes hand over some of their decision making to investment professionals. It's simply that those investment professionals are usually, hopefully, well qualified, fairly dull, and what they'll do is take out the emotion. All right, they may not be the kind of people that you want to dash out to the park with every day, but they are the kind of people that won't fall into these classic investing traps. And on that note, that cheery note, I'll hand straight back to Rachel.
I'm going to hand back to me, the fairly dull investment manager.
No, your current company excluded, quite good.
Thanks, Tim. Okay, so with that in mind, let's go and have a look at how our virtual portfolio has performed. So here's the table. So obviously on the left-hand side, we've got the list of stocks, and then we've got the price that we paid for each holding. So for the total portfolio, we paid £30,517. Next column, we've got the current value. So unfortunately, we have lost a bit of money. Our portfolio is now worth £28,928. Next column, we've got the move in each stock since we actually purchased the investments. So that would be about 6 weeks ago now. And then we've also got the gain or loss since our last session 2 weeks ago, just so you can see how some of these stocks have moved a bit more recently. So we have got some pretty big movers here. And this really ties in with Tim's comments about why you should have a diversified portfolio. So if we look at something like NEO or Peloton, both of those have lost about 30%. I mean, imagine if you put all of your money into one of those stocks and you were down 30% overall, you'd probably be feeling quite worried right now. Whereas, we have lost a bit of money, but by spreading our money across 12 different stocks, we've really lowered our level of risk. And overall, we've lost just over 5% so far, which it's not too worrying in comparison to what the rest of the market has done. But let's have a look at some of these individual names and have a think about why they've moved as they have. So the best performer for us has been IAG, which is the owner of British Airways. Now, last time we had our catch up, it was just after Boris Johnson had announced his roadmap for lifting lockdown. And he said that international travel would be allowed in the UK again from the 17th of May. And since then, everyone has gone absolutely mental booking summer holidays. And since then, British Airways has said they've experienced a 500% increase in the number of people trying to book holidays. So that's led investors to think, actually, they're going to have a pretty good year. So people have been piling back into the stock. So since we purchased the stock, we're up nearly 37%. And even in the period since our last catch up 2 weeks ago, the stock has gained nearly 15%. So that's by far and away the best performing stock in our portfolio at the moment. We've then got Lloyds Bank, so that's up just over 12% for us and about 3% since we last met. Now, earlier in this call, we talked about rising interest rates, and actually rising interest rates tend to be good news for banks because that means the banks can charge more for money that they're lending out to people who need business loans or mortgages. So banks like higher interest rates. Since our last meeting, we've also had the UK budget. So that's when our Chancellor of the Exchequer talks about how he plans to organise the UK finances over the next couple of years. There was some concern before the budget speech happened that he would really raise taxes quite significantly in order to raise some of the money that he needs to cover the cost of the coronavirus. However, that didn't happen. Instead, he said he would like to try and promote a bit more growth in the UK economy, and that too should actually be quite good for banking stocks. And that's probably another reason why Lloyds Bank shares have come up over the last couple of weeks. So those are the best two stocks in our portfolio. Then we've got a few in the middle that have moved a little bit. We've talked about some of these reasons already. One of the reasons some of these stocks have come down a bit is the fact that the dollar has weakened since we first invested our portfolio. And because most of these stocks are American, we've actually lost money on that currency. We also said at the start of this call that a lot of our stocks are quite growth orientated, and those types of stocks have sold off a bit over the last couple of weeks, again, because of these fears about inflation and potential higher interest rates. But then let's have a look down the bottom of the table to the biggest fallers. So we've got NEO, so that's down 29.5%. And just in the last 2 weeks, it's lost 14.6% of its value. And then Peloton, down over 30% since we bought. And in the last couple of weeks, down 11%. So let's go through the reasons for these particularly massive moves within the portfolio. So the first one I'm going to look at, so I'm going to come back to that chart. Let's look at Peloton to start with. So Peloton only joined the stock exchange back in 2019. And as you can see, it's had an incredibly successful first couple of years. So it joined the stock exchange in September 2019. The price was around about $100. It kind of plodded along quite nicely for a few months. And then when the first lockdown started, everyone started buying Peloton bikes. The company did really well. The share price went up quite dramatically. So it's gone up from 100 to over 600. So that's a huge rise in a very short space of time. However, now that lockdown is ending soon, you can see that the stock has started to sell off because investors expect that perhaps people will have less demand for Peloton bikes. Perhaps they'll go running outside again now that spring is here. Perhaps they'll go back to the gym rather than paying for a Peloton bike. For various reasons, Peloton shares are selling off because lockdown is starting to end. So that's why we've seen such a big move in our Peloton share price. I'm just going to go back to this one. So this is a chart comparing British Airways or IAG and Lloyds on the same chart. So this shows the percentage change in these two share prices over the last year. And I just thought it was quite interesting to show that they really both came down quite heavily at the start of lockdown, but they've both recovered quite well since then. And we fortunately bought in at quite a good time, and we have experienced some of that share price rise. So Lloyds Bank has done pretty badly from lockdown because no one was able to move house, no one was taking out new mortgages, the economy was slowing down. That tends to be bad for banking stocks. So you can see that Lloyds, that's the pink line, that came down quite heavily last year, but since then it has recovered quite well. IAG performed even more badly. Everyone stopped booking holidays because they weren't allowed to. So the IAG price basically fell off a cliff last March. You can see that huge plunge in the share price, lost over 50% of its value in just a few days. But since then, now that people are allowed to start booking holidays again, we have seen the share price recover quite notably. So that's IAG and Lloyds. We've looked at Peloton. Next one is NEO. So every quarter, companies are legally required to publish their quarterly accounts. And most companies at the time, they will have a conference that investors are allowed to attend, and they will run through their latest financial data, and investors are allowed to ask them questions. And quite an interesting topic came up on the NEO conference call that happened at the start of March. So someone asked about the potential ability of NEO to produce a certain number of cars. And here is the answer that the chief executive gave. So he said for the second quarter of this year, we will still have some risks regarding the chip supply. What he means is that to make an electric vehicle, you need to have lots of semiconductor chips. And they've actually really struggled to get hold of the volume of chips that they need. And that's really caused problems for them in producing the number of cars that they want to produce. So first of all, he says we've got some risks regarding our supply of chips. He's then said regarding the battery supply, so that's obviously another crucial component of electric vehicles. He said this is another constraint for our second quarter performance. And then he says, so because of the constraints on the battery supply and the chipset supply, our production capacity will be kind of limited in the second quarter to around 7,500. And to put that into context, this company was previously making about 10,000 cars per quarter, and now it's going to have to drop that to 7,500 because it's not able to get the components that it needs. So that is the reason why these shares were sold off quite heavily over the last couple of weeks. So if you were interested, you could go on the NEO website, you can have a look at their investor relations page, you can have a look at the statement that they've released regarding this, and if you wanted to, you could even listen to the recording of that investor call that took place, and you could hear the responses to some of these questions. But this is really the reason why the shares have sold off quite heavily. And then finally, obviously we've got Alphabet in the portfolio. In our last session, we did talk about how we like to look for investment ideas, and we also went through some different financial ratios. So what I thought I'd do is just really look very closely at one particular stock and just give you an idea of how I would look into a company that I first discovered and where I would go to look for different types of information and the kind of order in which I would look at that information. So let's use Alphabet as a starting point. So the first thing I would do, I would open my Yahoo Finance app, and I would have a look at the summary on there. So on the home screen there, you've got obviously the name of the stock, you've got the current share price, and what I would do, I would just have a quick scan of the graph over the last year, just to make sure there are no ridiculous moves, just to make sure it's not a super volatile stock, because that would really make me worry. I would then look at the details tab on the Yahoo Finance app, and that would just give me a quick summary of exactly what the company does, because sometimes companies do more than you might expect. So for example, on the UK market, there's a company called Associated British Foods, and it used to be a sugar production company, but now it owns Primark. So it's both a Primark owner and a sugar production company. So sometimes companies do a lot more other things compared to what they might be famous for. So it's really helpful to look at this summary and just get a sense for everything that this company does. And so Alphabet, obviously it's the company that owns Google, it's involved in so many different things. So you can see here, obviously it's got its main search advertising business, it owns YouTube, it's got all the different Google services like Gmail, it's got Google Maps, it's got Google Play. It really is a very diverse business. And this is, I think, a very helpful summary of everything that the company does. I would then go on to that key statistics page and just have a look at some of those key ratios that we talked about last week. So just as a reminder, at the top there, you've got the previous closing price, and then you've got the opening price for today's market trading session. Those aren't particularly interesting unless you're following the stock really closely and you're looking to sort of day trade, but that's not something that we would normally recommend, as Tim has said. You can also look at the 52-week low and the 52-week high to give you an idea of how much the stock has moved in the last year. So that can be quite helpful. You can look at the market cap. So that's the overall size of the company. So as you can see, this one's worth nearly 1.4 trillion. So it's an absolutely massive company. And this is where it gets interesting. So you can look at the price to earnings ratio. And this gives you an idea of how expensive the shares are in comparison to the amount of profit that the company is making. So normally we view about 15 as a fairly normal price to earnings ratio. So anything above that could potentially be viewed as being quite expensive. So if you were going to buy a company that had that kind of price to earnings ratio, you would want to know that the company had good growth potential to justify you paying that high price. So that's where the final slide comes in. That's where you can look at the revenue and the earnings that Alphabet has been making over the last 5 years. So the green bars on that chart there, those are the revenue or the total sales that Alphabet has been achieving over the last 5 years. And then in the blue, you've got the earnings, i.e. the profits that this company has been making. So what I want to see there is a really obvious upward trend. And luckily we can see that for Alphabet. And in particular, looking at those blue bars, I mean, in 2017, this company had profits of less than 20 billion. And in the most recent year, 40 billion. So its profits have doubled in that 5-year period. To me, that's a good level of growth. And to me, that justifies paying that fairly high price to earnings ratio. So that's how I'd start looking at a stock in terms of ratios. What I would then do is go and have a look at the investor relations page for that particular company. Now, there are lots of documents that companies legally have to put on their investor relations pages, so things like quarterly accounts and also the annual report. But lots of companies will put lots of other really interesting information on there, and lots of it is really easy to understand, even if you're not a professional investor. So looking at the Alphabet investor relations page, they have a letter every year that's been written by the Google founders. And this is just a really nice way to get a feel for what the company's doing and how it's trying to make money. So I think it's a really good way to get to grips with how this company operates. So this is just a really tiny extract that I've taken from the most recent letter. And so they've said that today our mission to organize the world's information and make it universally accessible and useful is as relevant as it was in 1998, which is when the company was first launched. And they say that since then they've evolved from a company that helps people to find answers to a company that helps to get things done. So initially Google was very much just a search engine, and now it's evolved to do all these other things as well. And I know that lots of you were particularly interested in YouTube. And the second paragraph on here is what the Google founders have previously said about YouTube. So it really is becoming an integral part of people's lives, and it really is a very useful resource, helping people to learn about lots of different things, as well as entertaining them as well. So you can have a look for various different things on the investor relations page. And then you could also have a quick look at some of the pages in the annual report. So I've just picked out one particular bit here. So this just compares the revenue that Google is making from different parts of its business, and it compares the revenue between 2019 and 2020. So you can see from search advertising, the revenue from that has gone up from 27 billion to 31 billion. So really nice rise there. YouTube adverts, they've gone from 4.7 billion to 6.8 billion. So you can see that's also a really nice rise in the space of just 1 year. So if you are particularly interested in the certain aspects of a business, you can go and have a look through the annual report and try and find out how that particular part of the business is performing. So that's just how I would start to look at a company. So if there are any companies that really interest you, I would just recommend going to have a look on the investor relations page of each of those companies and seeing what you can find. And that brings us to about 20 to 6. And so we'll pause there, and we've got a few minutes left for questions. And so if you do have any questions, if you could pop them in the chat box.
There's one I'll take on, Rachel.
Great.
Which is what was my biggest investing mistake of all the errors that I sort of listed for anchoring. Good example. When I came to London, this was a property example, actually. The property market had been in the doldrums for a while. A friend of mine actually managed to lose money on a property in London, unheard of, you might say. So the rest of us who couldn't then afford to get on the ladder didn't. And we said, well, you know, we're not going to fall into that trap. I mean, look what happened to our friend, you know, and he seems like a clever chap, trainee barrister, all the rest of it. So we left it a long time to get onto the property market, worried that we'd seen someone lose money in the past. And actually that became irrelevant quite quickly. The rules changed around buy to let and all sorts of things happened. And essentially, you know, sitting with that example from the past proved to be quite unhelpful because things moved on and we got a little bit left behind. Since then, you know, I'm old enough to have corrected that mistake, but at the time, that was a good example of anchoring, holding on to something that's become irrelevant.
Great. I'll take the next one, Tim. So we've got one about, should you sell a stock if it falls as much as 30%? Which is a good question because it really depends on the situation. If you are investing in stocks and shares, you do need to be prepared for them to rise and fall over time. But if one does come down very significantly, you really need to have a look at exactly why it's come down. So if we take a look at that NEO example, clearly there is a specific reason for why the shares have come down. And you need to consider whether or not you think the company can come back from that. And this particular situation with NEO, it does seem, based on what the company has said so far, that this is very much a temporary issue and they are looking to resolve that. So in my opinion, that's not a reason to sell the shares, but I would say that if you have got any shares that come down more than 20%, that is when you should just have a look and consider whether or not anything more serious is going on rather than just regular market volatility.
I'll just add to that, actually, Rachel. On that note, people do tend to agonize about shares that have gone down, and they tend to just sort of go, well, the ones that went up, well, clearly that's, you know, that's how great I am as an investor. But actually, if you're honest about it, you should sit down and analyze both gains and losses on a regular basis, because actually gains can just be luck sometimes, but people don't want to admit that. They kind of go, no, that was my skill that got those gains, and they spend all their time analyzing losses. And there is a thing called loss aversion. It's a human foible. It goes back to our time on the savannah when loss aversion stops you being eaten by things. But you know, in the stock market, it can mean people become obsessed with why did this go down, and actually they should be looking across the portfolio, saying what did I expect, and where are we against my expectation, positive or negative.
Mm-hmm. I've got another question here. Which share do you think will rise the most in the next 6 months? I mean, I wish I had the answer to that question because then I'd probably be a millionaire. So it's quite a difficult one to answer. Yeah. It really depends on what happens with the economy. So if lockdown eases and that all goes according to plan, if we don't get another spike in infections, if the vaccine rollout goes really well, then I think companies like IAG could continue to do very well because they're operating off a low base. So the share price has fallen a lot and it doesn't have to go up by much for you to start making money on it. And so I think that's potentially one that could do really well over the next 6 months. But it's impossible to say. It really depends with what happens in the economy. And that's exactly why we would never put all our money in one stock.
Just again, to add to that, Rachel, I'm talking to Terry Smith, who's been in the market for a long time. The way he views things, I don't know if you concur with this, is that he sees the market as very much K-shaped, if you like. In other words, there are firms across a whole raft of sectors that have got to grips with technology, with online research, selling with data, and they will continue to do well. his view is that we've had 10 years of change in a year over the last 12 months, and companies that have just forgotten about tech, not reorientated themselves towards new customers in China and all kinds of places around the world, people basically who have stuck to their guns in terms of products and so on, they are going to continue to struggle.
Yeah, agreed. And just to add a bit more to that question, actually, it also depends on politics. So we've now got Joe Biden as the president over in the US, and a lot of how these companies perform will depend on what policies he decides to enact. So he's already signed off this massive $1.9 trillion stimulus package, and that involves sending checks for $1,400 to almost every individual person in the US. So depends what these people spend that money on, but that could cause a few movements in the stock market. But now that he's signed off that massive stimulus package, his next point of focus is to start improving the infrastructure in the US. So he wants to improve things like train stations, roads, railways, and that could benefit companies like Xylem that we have in the portfolio. So lots of our companies could be quite sensitive to potential political change. Okay, we're almost at 1:45, so I think we'll leave it there. So thank you again to everyone for joining us. If you think of any more questions afterwards, do feel free to email them in, send them to events@killik.com, and we'll be happy to get back to you. But otherwise, have a good couple of weeks, and we look forward to seeing you in the final session. Thank you.
Thank you.